Hi everybody, today I'm going to provide you an update on my US and Singapore stock portfolio and also my unit trust portfolio, which I have just done a portfolio rebalancing on the unit trust where I replace some of the funds and also add in new funds. In this video, I'll share with you in more details about them. Let's take a look at my stock portfolio. The stock portfolio capital invested is 90,000, and based on the latest portfolio value is down about 0.25%. However, you can see that the stocks value have actually down about 5.66%. The losses is being mitigated by the dividend collected over the years, which I'll share about it later. Let's take a look about my portfolio changes since 26th of July, which is about 3 months ago. For the Singapore stocks, I have added more position to 4 existing counter. First is CapitaLand Invest, followed by the other 3 REITs counter, which is CapitaLand Ascenders, Mapletree Logistics Trust, and Mapletree Pan Asia Commercial Trust. I've started to add more of this position as the REITs market has started to come down due to current interest rate hike environment. And I'm looking at long-term view, which is why I add more position to these 3 blue chip REITs. And for the US side, I've added more position into Apple, Bank of America, and Visa. And this is the current portfolio holding where there is none of the Singapore counter have more than 5% weightage on the total portfolio. The highest is ComfortDelGro, we have 4.11%, and the lowest is OCBC, which currently have 1.44%. And I'm looking up for opportunity to add more position to OCBC. For the US stocks, similarly, none of the counter have more than 5% holdings. The highest one is Apple, which is 4.47%. And the lowest is Johnson & Johnson, which is 2.1%. Currently, I still have a cash balance of 39.35%. And my near-term target cash balance is around 20%, which means that I still can deploy another close to 20% more of capital into my existing holding or new holdings. Okay, this is the stocks performance for this portfolio since 1st of January 2022, and every month I've been constantly adding 4,000 to this portfolio. Over the past month, the portfolio has finally turned positive, but however, this month it has started to turn negative due to mainly the sell down on the REITs holdings and also the dip on the US market. This portfolio is focusing on income and growth at the same time, and thus majority of the counters are dividend paying stocks. And as of 25th of October, the total dividend cumulative collected is more than 1,002, which is why when the market currently down, although the stock value have dropped, some of them have dropped quite significantly, but the total portfolio is still able to hold well with a total net loss of 0.25%. One of the main contributing factor is the dividends collected have cushioned the downside effect. Now let's move on to my unit trust portfolio. The unit trust portfolio have been on a negative for slightly more than 5% as of 25th of October. And one of the main key reason is the global fund are not really performing that well, and also China have down. You can see that it is close to 20%, plus FSA dividend advantage, which is also have about at least 1/3 in China exposure, is also down about double digit 11%. Some of you may have observed that the fund I show here is a bit different from my previous update, as I have just recently made a rebalancing of the portfolio and make some changes to some of the funds. The portfolio since inception is down 7.54%. As I mentioned, that the main contributor is mainly the Asian market is not really performing that well. And also the global fund also have not really performed that well during this past 1 to 2 years. And this is the performance of this unit trust portfolio. It has actually finally turned positive sometime in July, but after that, it started to come down again, where the China market start to sell down again. So what are the changes I make to this portfolio? Okay, first is I have replaced these 2 global funds. One is called UOB United Global Quality Growth, and then it's called Nikko AM Shenton Global Opportunity. These 2 funds to me are still a pretty decent and good fund. However, their performance is not that ideal recently, and I decided to replace them with another two funds, which happen to be both from JP Morgan. And the first one is called the JP Morgan Global Dividend Fund, and then the other one is called JP Morgan Global Select Equity Funds. The key differences between these two JP Morgan funds is one is focusing on investing in dividend counter and it pay dividend monthly, and the other one is mainly focusing more towards a growth. Let's look at some basic information of this JP Morgan Global Dividend Fund. This is extracted from the fact sheet. From here, you can see that this fund actually have outperformed the benchmark, which is the MSCI All Country World Index, the total return net over the past 3 years, and thus is generating an alpha return over the past 3 years. This fund have a 53.7% weightage on US, which is pretty common for most of the global fund, where they will have more than 50% weightage on the US fund. This is the fact sheet of JP Morgan Global Select Equity Fund. This one have a longer track record compared to the Global Dividend Fund. Although the Global Dividend Fund have been there for quite some time, but the Sing dollar share class is only launched about 3 years ago. So for the Global Select Equity Fund, you can see over a long-term time horizon of 5 years and 3 years, it actually outperformed the market, and you have been generating a decent alpha over the past few years. And for this fund, you have a more weightage toward US compared to Global Dividend Fund, where you have 68.5% weightage on the US market. Let's do a comparison on how these two JP Morgan funds perform compared with the two funds that I've just replaced, which is the UOB United Global Quality Growth and the Nikko AM Shenton Global Opportunity. And this is based on data as of 24th of October. From this chart, you can see this is the JP Morgan Global Selected Equity Fund, the total return, and this is the JP Morgan Global Dividend Fund. They have managed to outperform the other two funds, which is the UOB and the Nikko AM, over the past 5-year time horizon. However, do take note that the JP Morgan Global Dividend Fund is Sing dollar share class is only launched slightly more than 3 years ago. But nevertheless, the 3-year performance is still better than the other two funds, which happen to underperform during this volatile market. The next is the Technology Fund. I have actually replaced the Aberdeen Global Technology Fund with Threadneedle's Global Technology Fund. One of the key reasons I replaced the Technology Fund is at this current market juncture, I would prefer to skew towards a Technology Fund that have a more focus on the US companies rather than more towards the global. For this Threadneedle Fund, they have actually overweight US compared to the index, which is 88.7%. The Aberdeen Global Technology Fund, for the US, they only have slightly more than 50% weightage. And at this current market juncture, I would prefer to have a higher weightage on the US market, which is why I decided to make a fund switch. And despite both funds are actually performing pretty well. And furthermore, about why I make the switch is also that for this Threadneedle Fund, they are big chunk focusing on the mid-cap tech stocks, where you can see from here, for the market cap of 50 billion to 100 billion, 25% of the fund is allocated there, compared to the index, 8%. For the index weightage, mainly 76, more than 3/4 of funds are on the big companies. But this fund decided to take another approach. They decided to put more weightage on the mid-cap company rather than follow the index to be heavily weight on the large or mega cap companies. If the market were to grow, usually the small cap will be more risky. The big cap will usually be less risky. But in terms of growth potential, why, of course, the smaller cap will move faster. So to take a balanced approach, I would prefer a fund that invests more on the mid cap, which is definitely less risky compared to the small cap. When it comes to capital appreciation, they usually move more compared to the big cap or even the mega cap. And this is a track record of this fund. All in all, this fund did not constantly beat the benchmark. And unfortunately, we can't really find a global technology fund that have able to constantly outperform the market. Over a near-term period of 3 and 5 years, I've seen that this fund actually have outperformed market, which is the time horizon I'm looking at for fund performance between 3 to 5 years. Since I started this portfolio in January 2022, my portfolio is a 100% equity portfolio, which is a very, very aggressive portfolio. So at this juncture, I decided to add in a bond fund to bring down the portfolio volatility, and also at the same time looking at the potential of interest rate hike being paused, and maybe in the future interest rate start to come down, and with that, bond will definitely benefit from that. So I decided to make a tactical allocation of 10% into a bond fund at this current market juncture. And the bond fund I have selected is a PINCO fund, which is called a PINCO Income Fund. And the share class I choose is the administrative share class, which have a lower management fee compared to the popular PINCO Income Fund, where it's the E-share class. This PINCO fund currently pay a dividend yield of more than 6%, and the dividend is paying on a monthly basis. But I have opted to reinvest the dividend at this juncture. And now concerned when I look at dividend fund, we are worried about dividend paying from capital. I have got confirmation from PINCO that they have never done that, paying dividend from capital. And also based on the fact sheet, we can look at currently their estimate yield to maturity is 7.78%. Due to bond price drop, bond yield have gone up, and their annualized distribution yield is 6.49%, which means that the dividend or the interest or the coupon payment collected by them from the bond they invested is more than enough to pay out dividend to investor. Although it is called a global bond fund, but currently it is very, very highly skewed towards the US market at this juncture, where I don't really have a concern on that. And this is the track record of this fund. This fund has been there for more than 10 years. And based on the track record, it has constantly outperformed the market at any time frame. What does that mean? Means that you look at even 1 month, 3 months, even up to 10 years, this is the benchmark performance. Where I look at the fund performance, it has constantly outperformed the market at any time frame. The first priority for me to select unit trust, I'm looking for unit trust that can outperform the market in all time frame. That is the first choice. After that, the second choice will be look for unit trust that are able to outperform the market over a longer term time frame. Sometimes short term, the market is quite volatile. It may be difficult for the fund manager to outperform the market, but we want to look at the long-term side, especially when we do unit trust investment. We are looking for the longer term rather than trading for the short term. So I'm quite comfortable with this fund, which is why I decided to put this fund in. However, do take note that to some of you that the return may not be that attractive over long term. It's only 3% return. The objective is to bring down the volatility of the portfolio and also looking at the potential upside gain in the near term. If interest rate were to pause or hike maybe in 2024 or maybe early 2025, the bond price will definitely able to appreciate. Okay, will able to appreciate. What does it mean? Means that there will be a potential capital gain, capital upside on the fund itself. One thing to take note, this fund have actually increased their dividend payout in last year, and not only one, it increased the dividend payout twice last year. When the interest rate is increasing, they have actually increased their dividend payout also. Why is that so? Is because the bond yield have went up and they have collected even more dividend, and thus they have decided to pay out even more dividends. So one thing to note is the dividend payout, if you are an income investor looking for dividend, when the interest rate start to come down, there is also a potential they will normalize the dividend payout to before interest rate hike level, because the bond yield have come down, so definitely they will have to pay lesser. So that is something that investors need to take note on that. But however, at the current market juncture, because of the low bond price, there is also a capital upside potential, and this will able to cushion the dividend cut as there's a potential capital gain on that. So this is the allocation for my portfolio. For the JP Morgan Global Dividend Fund, I do not have the 5-year data as this fund is less than 3 years old. So I use the lower of the index return, which is actually more than 8%. I bring down to 8%. And this fund has outperformed the index over the past 3 years. So the return, I would say that will be a conservative return in that aspect. And for this PINCO fund, as the administrative share class, I do not have the data for the 3 and 5 year returns. Thus, I use this share class where most people like who have invested in is the E-share class. We tend to plot it here. But do think note that the administrative share class, the management fee is lower, and thus the actual return actually is higher. So based on this allocation, I have 30% actually into a global funds, 15% each, 25% in the US market, which is the Infinity US 500 Stock Index. And I have reduced the Asian weightage, FSA dividend advantage, to 15%. For the tactical allocation, the Trade Leader and the JP Morgan China, I still maintain at 10%, which means that actually I trim the global technology fund, which I actually performed quite well, and the weightage has exceeded 10%. So I rebalance it back to 10%. And for this PINCO bond fund, I start with a tactical weightage of 10% first. And all these 7 funds, I do a monthly RSP of $100 per month to them. So the total monthly RSP for this portfolio is $700. But along the way, I will also may do a ad hoc top up to selected fund, depend on market conditions, which I will update when I do the portfolio update in my next video. So the current portfolio volatility is 15.49%. That is based on 3-year standard deviation. And from here, you can see that I add in the bond fund, which is only have a single digit volatility. This will actually bring the volatility of portfolio slightly lower. And the 1-year annualized return actually is about 10.62%. And the 5-year annualized return is 6.75%. Do take note, this is based on past performance and based on the past 5-year data. To me, the market is a bit decoupled, where you can see that Singapore market, China market, and US market all seems to move in different directions. The portfolio maximum drawdown is close to 24% over the past 3 years, which can be quite risky to certain investor. And we can see that the maximum drawdown for the China fund is more than 50%. And do take note that this is not a buy and sell recommendation. And the fund that I have removed doesn't mean they're bad fund. It's just that at this current market juncture, I relook at my portfolio, I decided to make a switch. I may switch back to the fund that I removed going forward if the market have condition have changed and the fund performance have changed also. That's all I have to share with you on this portfolio. And if you feel that it have benefit you, do remember to like and share and also leave your comment below. And lastly, remember to subscribe to this channel so that you'll be notified on my next video. I shall see you in my next video. Goodbye.